What are the pros and cons of a call calendar spread? If you are curious about the call calendar spread and how it can fit into your options trading strategy, you are in the right place. Let's break down the pros and cons of this approach to help you understand its potential benefits and drawbacks. A call calendar spread involves selling a short-term call option while simultaneously buying a longer-term call option at the same strike price. This strategy is often used when traders anticipate that the underlying stock price will stay close to the strike price in the short term, with a chance for a moderate rise later on. One major advantage of this strategy is defined risk. The maximum loss is limited to the initial cost paid to enter the position, which is the difference between the long and short call options. This can provide peace of mind for traders who prefer a more controlled risk environment. Another benefit is the potential to profit from time decay. The short-term call option loses value faster than the long-term call option. This means traders can buy back the short call at a lower price or let it expire worthless, allowing them to keep the premium received from selling it. Additionally, if implied volatility increases, the long-term call option may gain value. This can add to potential profits, especially if the market becomes more volatile. The call calendar spread also works well if the stock price stays near or slightly above the strike price by the expiration of the short call. This allows traders to benefit from minimal price movement initially and possible upward movement later. However, there are some downsides to consider. The strategy has a limited profit window. It profits most when the stock price is near the strike price at the expiration of the short call. If the stock moves significantly away from the strike price, profitability can decrease. Another con is the initial debit cost. Entering the spread requires paying a net debit since the longer-term call is typically more expensive. This amount represents the maximum potential loss if the trade does not go as planned. Traders also face exposure to changes in volatility. If implied volatility decreases, the value of the long call option may drop, negatively impacting the position. Moreover, managing this spread can be complex. It requires monitoring and potentially adjusting as expiration approaches, especially if the stock price moves significantly. Finally, after the short call expires, traders are left with just the long call option. This exposes them to directional risk without the premium offset provided by the short call. In practical terms, a call calendar spread is useful for traders expecting low volatility or sideways movement in the short term but anticipating a price increase later. It is important to choose the right timing and strike prices to maximize gains while minimizing risks. Understanding these pros and cons can help you decide if this strategy aligns with your trading goals.